If you remember back to the housing market expansion in the early 2000s, we saw the growth of ninja loans as they were a segment of the home sales explosion. Ninja is an acronym for no income, no job, and no assets, which meant that the lenders were making loans to people who were not required to prove that they could repay the loans. It wasn't that they did not necessarily lack income, jobs, or assets, it was just that they did not need to bring proof of any to their lenders. Some of these loans worked out fine, but you can imagine how many ended up in foreclosure. Lately, I've been getting feedback from viewers who are worried that ninja loans are back in force and are driving the increase in home sales for the past few years. Today's video explores the current mortgage pipeline as reported by Black Knight, which allows us to forecast the future of loan delinquencies and comment on the impact of ninja loans today on the U.S. housing market. Things are changing in the mortgage industry. The mortgage delinquency rate rose nearly 2%, but as we'll see later in the report, delinquencies are now at pre-pandemic levels and recently set a new all-time low. Black Knight reports that foreclosure starts dropped more than 25% and remain well below pre-pandemic levels. Any fears of a pandemic-induced foreclosure crisis have been put to rest. Prepayment activity remains at a 3-year low, which is understandable as the dwindling supply of distressed property, coupled with rising mortgage interest rates, has cooled the refinance activities that had been the top solution for delinquent borrowers due to the pandemic. Before we move on, let me emphasize the importance of each ensuing step in today's report. It will allow you to understand the bigger picture of ninja loans and the overall mortgage pipeline instead of a simple answer where you might not fully understand how it was developed. Occasionally, I'll get feedback from a first-time viewer on our channel saying that my analysis was incomplete, missing an important data point that could have changed my conclusion. What most new viewers don't understand is that I report weekly, and I'm trying to keep my videos brief. Each time I report on the housing market, I attempt to make it a standalone analysis, but in reality, it's a continuation of all the other evidence I've produced in recent videos. I would encourage you to click the thumbs up like button and subscribe to our channel so that you understand the full picture and get all my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to evaluate the facts and ignore the hype that is so prevalent online, then subscribe now and I'll keep you in the know. This graph plots the national delinquency rate on first-lien mortgages, an excellent barometer for anticipating a foreclosure crisis. It reports the percentage of mortgagors that are not up to date on their loan payments. The dark line plots the quarterly delinquency rate, the light green line plots the average recorded from 2000 through 2005, and the gray line plots the record low delinquency rate. Here's what we can conclude about the national delinquency rate. The national delinquency rate rose slightly to 2.89% in July and is now slightly above the all-time low set a few months ago. The national delinquency rate is now 36% lower than the pre-Great Recession July average of 4.51%. With more than 20 years of history in the graph, it's clear that today's borrowers are making their payments at a historically high rate. These observations demonstrate the health of the current housing market in terms of distressed properties and refutes any current claim that a flood of foreclosures is heading our way. But let's dig deeper. This graph segments mortgage delinquencies by severity so that we have a better understanding of the extent that borrowers are failing to make payments. Overall, the trends are very positive, with the worst delinquencies showing huge declines and only new delinquencies showing gains. Perhaps the best takeaway from this graph is that only short-term delinquencies are rising, albeit at a very slow pre-pandemic rate. This is a very important point that most real estate hypesters either fail to understand or purposely overlook in reporting. Banks were not allowed to foreclose on most home loans that were delinquent during the pandemic until this year. So if a foreclosure wave was heading our way, we would have seen a huge number of foreclosure filings beginning in January. But we did not. And here is why. The total number of delinquencies has been reduced by more than half since the start of the pandemic 2 years ago, and delinquencies are now lower than pre-pandemic levels. That's the teal line in the graph. Serious delinquencies, those that have been delinquent for more than 90 days, have declined greatly in the past 17 months and are approaching the pre-pandemic level. This graph provides information about the number of loans on active forbearance plans. As a reminder, a forbearance plan is an agreement between a borrower and a lender that, for an agreed-upon period of time, allows the non-payment or partial payment of a loan to help the borrower retain the home. When the pandemic hit, many Americans feared for their jobs and panic ensued. As part of the CARES Act, lenders were required to offer voluntary forbearance plans to borrowers to help them through the turmoil. There were nearly 5 million borrowers who went into forbearance at one point early in the pandemic. This action caused many self-proclaimed real estate experts to come out and call for a foreclosure wave that would cause massive home price declines in 2020 and 2021, and then again in 2022. They were wrong each time. As I had warned, home prices soared during those years due to the limited supply of homes for sale, and equity growth for homeowners created opportunities for most borrowers to resolve their issues without a foreclosure sale. The remaining pipeline of loans and forbearance continues to decline and soon will be just a footnote in the housing market history. As you'll see in the following pie chart, the forbearance plans successfully protected homeowners during the initial panic of the pandemic. This pie chart makes for a great picture as it shows what has happened to the 8.2 million loans in forbearance that were COVID related. It shows more than 8.2 million borrowers have been in forbearance at some point since the onset of the pandemic. 92% have since exited their plans, with 52% returning to making mortgage payments and another 32% having paid off their mortgages in full. Another 7% are still currently active in forbearance plans, leaving about 8% that are working through loss mitigation plans. Considering the equity growth of the past 3 years in housing, the majority should be able to satisfy most liens by selling their homes. This graph displays the Black Knight Home Price Index, which I've included demonstrating that its data on home prices parallels my findings from several other data sources. I would not say that Black Knight is the best source of information to garner average home prices around the U.S., but I can tell you that it reports look familiar. The 1-month percentage change in home prices is shown in blue and recorded on the right vertical axis, and the annual home price growth rate in green is recorded on the left vertical axis. As our previous reports have shown, home prices are soaring with the current rate of 14.5% per year. Home sales began cooling back in April due to sharply rising 30-year rates, and in July we saw the first decline in the 1-month home price since 2019. Lately, average home price declines are being reported in many markets, but I'm not certain that the average home is dropping in value. It will take many more months of data to validate price changes versus value changes, and this is a hugely important point for you to understand. When mortgage interest rates rise, buyers cannot afford to spend as much money, thus we see the average home price fall. But this does not necessarily mean home values are falling. Over the long run, home prices and values move in parallel, but during market changes, we often see them go in separate directions. For example, when interest rates fall, buyers can spend more, so in a market saturated with inventory, like we saw from 2006 through 2012, there were many times when average values fell while average prices rose. The key to average home values rising or falling is the supply and demand dynamic, which today still favors values rising. We would need a large influx of new construction coupled with continued rising mortgage interest rates to threaten home values, both of which could very well occur over the next few years. One way to measure home affordability over time is to examine the ratio between monthly mortgage payments and borrowers' income. This graph plots the national payment-to-income ratio. It is measured as a share of the median income needed to make the monthly principal and interest payment on purchasing the average-priced home using a 20% down, 30-year fixed-rate mortgage at the prevailing interest rate. The monthly payment required to purchase the average price home with a 20% down payment has declined in the past few months, but it is still far too high. I believe the recent improvements are due to rising wages, but we'll need to see the trend continue for a while longer to confirm this. You can view my recent video on wage inflation for more on this topic. This graph plots the current supply and demand for homes in the U.S. by reporting the months of supply of homes for sale. As a reminder, 6.0 months of supply has traditionally been regarded as a balanced market, where neither sellers nor buyers have an advantage in the market. The good news is that the relative supply of homes has risen. Unfortunately, it is due to declining demand, not rising supply. Though not shown here, today's supply of just over 1.3 million homes is far fewer than the 4 million plus homes in inventory at the highest point back in June of 2007. That means that today's supply is 70% lower than the market observed at its peak, and it's just above a 23-year low. I've been pleading for more inventory from builders since 2017, and I've produced MLS reports and graphs from Fred to support my concerns. Today, I've included a Black Knight graph confirming a major inventory shortage. Active listings remain 45% below pre-pandemic levels, though several markets around the U.S. have inventory levels higher than before the pandemic. As an aside, it explains why I get comments on my videos and articles with people expressing concern for rising inventories. If you're in Las Vegas, San Francisco, or San Jose, California, you have inventory levels higher than what was available immediately before the pandemic. But when we look at the overall U.S. housing market, the inventory of homes for sale remains far too low. It's important to understand the bigger picture with this graph, comparing inventories today with average inventories from 2017 to 2019. In 2017, the market had already hit a deficiency in the number of available homes. So the fact that we're another 45% fewer today explains why home values and rents have soared. This graph shows the percentage of homeowners underwater with their mortgages during the second quarter of each year going back to 2004. It plots the negative equity rate on the left vertical axis and the total market combined loan-to-value on the right vertical axis for the second quarter of each year. The second quarter posted the lowest quarter-end negative equity rate on record, with fewer than half of 1% of all mortgage holders owing more than their home's current market value. Total first and second lien U.S. mortgage debt was equivalent to less than 42% of the value of homes securing such debt, marking the lowest total market leverage on record. To be clear, the average mortgaged home in America has a combined loan-to-value of just 42%. Contrast the peak of bad times in 2011 that resulted in 28.2% of all mortgages owing more than the mortgaged homes were worth with today, where less than 1/2% of all mortgages are upside down. The black vertical line separates reality from speculation to show what would happen if home values fell. With a 5% decline in home values, less than 1% of all mortgages would be a negative equity position. With a 10% decline, less than 2% would be negative, and a 15% decline would result in less than 4% being negative. There's significant equity in the housing market, more so than at any other time in the past. For most borrowers who become delinquent today, the remedy does not have to be a foreclosure sale. Instead, delinquent borrowers can sell their homes on the open market, repay their debt, and many will walk away with cash. This graph from Black Knight reveals what it describes as tappable equity in the housing market. It's an estimated amount of money that could be withdrawn while still maintaining an 80% or lower loan-to-value ratio on the homes in the U.S. market. While low inventory levels and rising home prices have distressed home affordability, they have simultaneously created record levels of equity growth for existing homeowners. Tappable equity, the amount a homeowner can borrow against while keeping a 20% equity stake, hit its 10th consecutive quarterly record high in the second quarter this year at $11.5 trillion, but appears to have peaked in May. Escalating declines in June and July have total tappable equity down 5% over the past 2 months, suggesting a sizable reduction is likely in quarter 3, which would mark the first quarterly decline in 3 years. Currently, the tappable equity in the housing market is double the level recorded during the housing bubble in 2006. So, now to address the question that prompted me to produce this video. Will ninja loans bring down the housing market again? After today's thorough analysis of the current mortgage pipeline, you can rest assured that ninja loans are no threat to the U.S. housing market. The pipeline sits at or below pre-pandemic levels for defaults, and there is more equity in the housing market than ever to help aid homeowners falling behind on their loans. Our final graph in today's report comes from CoreLogic data that shows the average credit score of homebuyers for the past 20+ years. It reveals that the government made it harder to obtain financing for home purchases in 2008, and it has only gotten tougher. The orange line in the graph reveals the average borrower in 2001 had a credit score below 700, whereas today it's above 720. The green line shows the worst borrower has seen the credit score requirement rise from 500 to well over 600. In simple terms, this graph shows the death of a ninja loan. Ninja loans were more common before the 2008 financial crisis. In the aftermath of the crisis, the U.S. government issued new regulations to improve standard lending practices across the credit market, which included tightening the requirements for granting loans, the impact of which is very clear in the graph's green line. At this point, ninja loans are rare, if not extinct. Regarding the current mortgage pipeline, it looks incredibly strong, but some trends are turning. We're coming off a record low for the inventory of homes for sale and the month's supply of homes, so we'll continue to monitor consumption in the housing market. The biggest threat to housing remains home affordability, but as wage inflation grows, we could very well see continued improvement in the amount of disposable income being spent on buying and renting homes. Will builders deliver too many homes for the dwindling number of home buyers after the Fed raises rates again and again? Or will wage inflation-aided demand return as builders struggle with supply chain issues and slow-to-market timeframes? These are the trends we're monitoring, and we'll continue to report with data-centric clarity as the future months unfold. If you think I've missed a key point in this mortgage pipeline report, please share it with us by posting a comment below. If you want to see a video featuring my 9 tips for buying a home in a highly competitive market, you can view it by clicking on the box in the top left corner of your screen. To see a popular video featuring my top 6 home selling tips, just click on the box below it. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.